Imagine a company that's gone through this pretty dramatic transformation, impressive revenue growth, right?
Yeah.
But the stock price, well, it's been under pressure.
Yeah, and the big question, the one we're tackling today, is can it finally turn that growth into real, sustainable value for shareholders?
Exactly. Welcome to the deep dive. We take your sources, unpack them, and hopefully give you a shortcut to being truly well-informed.
Today, our mission is to dissect Enovis Corp. That's ticker symbol ENOV. It's a medical technology powerhouse.
We'll dig into its journey, its financial health, what the future might hold, all anchored to a share price of $30.44 as of August 21, 2025.
And we've structured this deep dive into two parts to make sense of it all. Part one is the foundation, the business itself, the management, the financials.
Then, in part two, we'll shift focus. Look at market sentiment. Who owns the stock, the risks, the opportunities, and try to pull it all together into an outlook.
Makes sense.
But before we jump in, just a quick note. If you like what you hear today and you want more deep dives like this one,
Yeah, head over to the Stock Analytics AI YouTube channel. Like and subscribe.
definitely. And for just €4.99 a month, members get priority deep dives. We're actually planning to cover all the S&P 500 stocks over the next few months, and members get first dibs.
Or, if you just want a one-off analysis on a specific company you're interested in, you can drop us a super thanks.
Great way to support the channel. Okay, ready to start?
Let's do it, kicking off with part one, the foundation.
All right, and we begin with Chapter 1, Business Analysis.
So the core question we teased earlier, Enovis has grown aggressively, mostly through acquisitions, right? Now they have new leadership.
Ah.
Can they finally translate that top-line success, all that revenue, into the sustainable value the market seems to be waiting for? That's the million-dollar question, or maybe $1 billion, given their revenue.
It really is. So Enovis Corp, ENOV on the NYSE. What's their core business?
Well, they're a medical technology company, and they run a vertically integrated model. So R&D, manufacturing, service, they handle pretty much all of it.
Gives them control.
Exactly. And their operations are basically split into two main segments. First, prevention and recovery, or P&R. Think braces, supports, rehab equipment.
Okay.
And second, reconstructive, or recon. That's more like joint replacements, surgical solutions.
And how are those segments doing? I saw some recent numbers.
Yeah, Q2 2025 figures, P&R brought in about $291 million. Recon was close behind at $274 million.
Pretty balanced.
Well, in terms of size, yes, but the growth story is different. Recon grew 11% year over year. P&R, only 5%.
Ah, okay. So Recon is definitely the growth driver right now.
Clearly. And beyond just selling devices, they also make money from, licensing, maintenance contracts, training fees for surgeons, that kind of thing.
Interesting. You mentioned a flywheel effect between the segments.
Yeah, it's subtle but clever. Think about it. Someone twists their knee, gets a DonJoy brace that's P&R, they have a positive experience with the Enovis brand. Years later, maybe they need a knee replacement. That's Recon. Because they already know and trust the brand from the brace, they might be more inclined to consider an Enovis implant. It builds loyalty across the patient journey.
That makes a lot of sense. It connects the everyday recovery stuff with the high-value surgical side.
Precisely. And product-wise, their portfolio is huge. Over 1,000 devices, more than 1,200 patents.
Wow. Any big names?
Oh, yeah. In P&R, you've got iconic brands. DonJoy, they've been leaders in knee braces for over 40 years. Aircast for ankle supports, that's 30-plus years. Also ProCare, Chattanooga for rehab gear.
Household names in orthopedics, really.
Absolutely. Then in Recon, there's Enovis Surgical for the joint replacements and specialized foot and ankle stuff like Trilliant and MedShape.
And they have tech too, right? Not just devices.
Definitely. They call it enabling technologies. The big ones are ARVS, which is an augmented reality system for surgical guidance, think heads-up display for surgeons. And MotionMD, which is software that helps automate the workflow for things like fitting braces and supports in clinics. It makes things more efficient.
So they're building an ecosystem, not just selling parts.
That's the idea. Now, scale-wise, they're global. Over 7,000 employees, more than 30 facilities. Trailing 12-month revenue as of Q2 25 hit $2.19 billion.
Almost $2.2 billion.
Yeah.
But you said their market cap is only around $1.7 billion.
Yeah, that's the paradox. Operationally significant revenue, but valued as a small cap stock, much smaller than giants like Stryker.
Which could mean more room to grow, but also more risk.
Potentially, yeah. More agility, perhaps, but less firepower than the big players. Their value proposition boils down to clinically differentiated solutions for better patient outcomes and transformed workflows.
Better for patients, more efficient for doctors.
Exactly. And it's all guided by this philosophy they call Enovis Growth Excellence, or EGX. We'll definitely come back to that.
Okay, EGX. Got it.
Hmm.
So that's the company. How does it fit into the wider industry? Let's get into the industry analysis.
Right. The overall market is huge. Global orthopedic devices, around $65.8 billion in 2025. And it's growing steadily, maybe 4.34% CAGR projected through 2034.
And the broader MedTech market.
Growing even faster, maybe 6% CAGR. This isn't just random growth, though. There are big trends fueling it.
Quite cool.
Well, aging demographics is a huge one. More older people means more need for orthopedic solutions. Then there's technological innovation, AI, smart implants, 3D printing, AR.
Which Enovis is tapping into with AR.
Exactly. And the third big trend is the shift to minimally invasive procedures. Patients want faster recovery.
Makes sense. But it sounds like a crowded space. Competition must be tough.
Oh, it's intense. You have the giants like Stryker and Zimmer Biomet.
Yeah.
Then smaller specialized players, even parts of diversified companies like Dover are in the mix.
So how does Enovis compete?
They rely on that clinical innovation, their strong P&R brands, DonJoy, Aircast, and building that integrated ecosystem with tech like ARVS and MerchantMD.
And the regulatory side. MedTech is heavily regulated, right?
Extremely. The US FDA, the EU MDR oversight is stringent. Getting a device approved is costly. Think over $30 million for even a medium-risk device.
Wow.
And regulations like the EU MDR have made things even more complex and expensive, maybe tenfold for some certifications. Plus, new areas like cybersecurity are now under scrutiny.
That sounds like a huge headache.
It is, but it also acts as a massive barrier to entry. It protects established players like Enovis. It's part of their moat.
Ah, the moat. So high R&D costs, complex regulations.
Yeah.
What else builds that moat?
Intellectual property is huge. Enovis has over 1,200 patents. And then there are the relationships. Surgeons build deep trust and familiarity with specific systems and manufacturers. Switching is a big deal.
High switching costs. Okay, so summarizing their competitive advantage.
Number one, brand strength. DonJoy, Aircast, decades of trust. They were even named a most admired company in 2024.
That helps. What else?
Cost advantages, economies of scale. That global footprint, 30-plus facilities, and the EGX system focused on continuous improvement should, in theory, help optimize production and costs.
Should. Okay.
Then those network effect switching costs we talked about. Surgeons trained on Enovis systems, hospitals using MotionMD, they're kind of locked in.
And finally, unique assets.
Definitely ARVS, the augmented reality system. That's a clear technological differentiator. But maybe the most valuable unique asset is that EGX system itself.
Why so important?
Because it's their operating model, derived from the famous Danaher business system. For a company built on acquisitions, successfully integrating them using EGX is absolutely critical to making the whole thing profitable. The bull thesis really hinges on EGX working.
That makes the management team incredibly important then. Which leads us perfectly into Chapter 2, Management Evaluation.
Right. And there's been a big change at the top. Damien McDonald took over as CEO just back in May 2025.
And the company has a history of big moves, right?
Yeah, they haven't been shy about transformation. They were an industrial conglomerate, then spun off their ESAB business and became a pure-play MedTech company, largely through that massive $3.15 billion DJO acquisition in 2019.
So McDonald steps into this transformed company. What's his background?
He was CEO at LivaNova before this, and importantly, held key roles at Danaher.
Danaher again. So the market probably sees that as a signal for continued focus on execution, using that EGX playbook.
Exactly. It suggests discipline, operational rigor, which is arguably what Enovis needs right now after all that rapid expansion and acquisition.
How are they on transparency and ethics?
Seems solid. They have a code of conduct, compliance programs, hotlines. And importantly, in the Q2 2025 earnings call, McDonald was very clear. He gave a granular view and explicitly said the strategy is shifting from build mode to scalable, capital-efficient execution.
That kind of directness is good. Investors appreciate that.
Absolutely, and it ties directly into capital allocation. The past few years were all about M&A. Buying Lima Corporate in 2024 for $800 million, integrating maybe 10 companies recently.
Which built the scale but added a lot of debt, I assume.
You got it. Significant debt. But the new message is crystal clear. McDonald stated, our capital allocation priority right now is debt reduction.
A major pivot from buying to digesting and optimizing.
Precisely. So don't expect dividends anytime soon. The yield is 0.00%. No big share buybacks either. All the capital is going into organic growth, integrating past deals and paying down that debt.
Which brings us to return on invested capital, ROIC. How are they doing there?
Well, not great currently. ROIC measures how well they generate profit from the capital they've invested. Right now, Enovis's ROIC is negative.
Negative why?
Mainly due to big GAAP operating losses. Remember that $645 million goodwill impairment charge in Q4 2024? That's basically writing down the value of past acquisitions that haven't performed as expected. These charges tank the GAAP profit.
So the money they've invested isn't generating positive returns on paper yet.
Correct. Their ROIC is below their weighted average cost of capital, WACC. The cost of their funding is higher than the returns they're generating, according to GAAP.
So the whole investment case really boils down to management using that EGX system to turn things around, drive actual operating profit, NOPAT, and get that ROIC up.
That's it. In a nutshell, it's all about execution from here.
Okay, let's dig into those numbers more deeply then. Time for Chapter 3, Financial Analysis. Starting with the basics. Market cap around $1.71 billion. Small cap status.
And like you said earlier, that cap is down nearly 35% over the past year. The market is definitely skeptical.
But the revenue growth has been strong.
Very strong, actually. Over the last 5 years, revenue essentially doubled, from $1.1 billion in 2020 to over $2.1 billion in 2024. That's a 17.1% CAGR.
Impressive growth. And they expect that to continue.
Yeah, they raised their 2025 guidance, now expecting $2.245 to $2.275 billion, which implies solid organic growth between 6.25% and 6.75%.
Okay, revenue story looks good, but now profit margins. This is where it gets messy, right?
Exactly. The contrast is stark. Their adjusted gross margin is healthy, 60.5% in Q2 2025. That's good for the industry.
Right.
But their GAAP operating and net margins have been consistently significantly negative. Huge losses on paper, like a $776 million operating loss in 2024. Trailing 12-month net margin as of March was almost negative 38%.
Ouch. Why the big gap between gross and operating net?
It's those large non-cash charges. Amortization from acquisitions, and especially that big goodwill impairment we mentioned, they hit the GAAP numbers hard.
So the argument is the underlying business is healthier.
That's the bull case argument, yeah. They point to adjusted EBITDA. On that basis, which strips out those non-cash charges, interest, taxes, etc., they are profitable. 17.2% margin in Q2 25, and they forecast $392 to $402 million for the full year 2025.
So it depends which metric you focus on. GAAP looks bad, adjusted EBITDA looks okay.
It's the core debate. Now, related to that is free cash flow, the actual cash generated after running the business and investing.
How's that looking?
Concerning. It's been volatile and negative in 2 of the last 3 fiscal years. They burned through $158.6 million in 2022, another $67.2 million in 2024.
Burning cash is never good.
Definitely not sustainable. That's why the new CEO's emphasis on cash generation is so crucial. They have to turn that around.
And earnings consistency. I guess that follows the profit margins.
Yeah, non-existent on a GAAP basis. Highly volatile, mostly negative EPS, like -$14.93 per share in 2024. Investors really have to rely on the company hitting its adjusted 2025 EPS guidance of $3.05 to $3.20.
Okay, shifting to financial stability, what about debt?
The debt-to-equity ratio is 0.54 or 54%. Total debt around $1.39 billion. It's high, no doubt, but it has come down from over 66%. The focus on debt reduction should help.
And liquidity. Can they pay their short-term bills?
Yes. Their current ratio is strong at 2.25 as of Q2 25. Plenty of liquid assets relative to near-term liabilities.
And, as we said, no dividend.
Correct. All cash focused elsewhere.
So let's talk valuation analysis. Given the negative GAAP earnings, PE ratio isn't very useful.
Right. Traditional PE is meaningless here. We have to look at forward-looking metrics or other ratios.
It's like?
Well, based on that adjusted EPS guidance, the forward PE is around 9.1, which sounds pretty low.
Very low for MedTech usual. What about price to sales or book?
Also look low. Price to sales, PS, is 0.77. Price to book, PB, is 0.66. All these multiples suggest the market is applying a significant discount due to the lack of profitability and the execution risks.
Deep skepticism baked into the price. What about intrinsic valuation? Did the analysis include a DCF?
Yes, a discounted cash flow model attempts to estimate intrinsic value based on future cash flows. Briefly, you project out cash flows, discount them back to today's value.
And what did the educational model suggest for Enovis?
It suggested an intrinsic value of approximately $52.20 per share.
$52.20, compared to the current price around $30. That's a huge potential upside, almost 71%.
Potential upside, yes. But DCFs are very sensitive to assumptions.
What were the key assumptions driving that $52 estimate?
Two critical ones. First, a long-term growth rate assumption of 4-6%, which is broadly in line with the MedTech industry. Second, a discount rate, or WACC, of 9-11%.
It seems a bit high for a WACC.
It reflects the risk. Enovis has a high beta 1.7 to 1.8, meaning its stock price is much more volatile than the market overall. Plus, you have to factor in the high debt and the current unprofitability. A higher discount rate accounts for that higher risk.
Okay, so significant potential value if they execute and hit those growth and cash flow projections.
That's the crux of it.
All right, that wraps up the fundamentals. Let's move into part 2, the future landscape.
Okay. Starting with Chapter 4, market sentiment. How does the market actually feel about Enovis right now?
Well, it's fascinatingly contradictory. On one hand, Wall Street analysts seem to love it. The consensus rating is a strong buy, at least 6 active buy ratings.
And their price targets.
The median 12-month target is $52, right in line with that DCF estimate, actually. The range is pretty wide, though, from $41 up to $70. But overall, analysts are bullish.
And the recent news flow. Media tone.
Mostly positive, especially after the Q2 2025 earnings beat and raised guidance. The stock jumped almost 12% pre-market that day. The narrative is shifting towards execution under the new CEO.
Okay, so analysts and recent news look positive. But what about other market indicators?
This is where the contradiction comes in. Short interest is really high. 12.3% of the float is sold short. That's about 6.88 million shares.
12.3%. That's significant. It shows a lot of traders are betting against the stock.
Exactly. High skepticism reflected there. Of course, it also means potential fuel for a short squeeze if things go well.
True. What about moving averages? Where's the price relative to key technical levels?
Right now, at $30.44, it's just slightly below the 50-day moving average of $30.70. Suggests some consolidation, maybe?
But the longer-term trend, the 200-day...
That's not looking good, technically. The price is significantly below the 200-day MA, which is around $38.50. That's generally seen as a bearish signal, indicating a sustained downtrend.
So, bullish analysts, bearish short sellers, and a technically weak chart. A mixed bag indeed.
Definitely. Now let's look at Chapter 5, ownership structure. Who actually owns ENOV stock?
It's overwhelmingly owned by institutions, 98.8% institutional ownership. That's exceptionally high.
Suggests the smart money has confidence, or at least interest.
You could interpret it that way. It's also very concentrated. The top 25 shareholders own over 77% of the company. And the top 5 alone, BlackRock, Vanguard, American Century, Dimensional Fund, Davenport control over 41%.
Wow, very concentrated. Okay. What about insiders, management, directors?
Their direct holdings are quite low, only about 1.11%. But there was a really interesting recent transaction.
Oh, yeah.
On August 13th, just recently, an executive VP, Daniel Pryor, bought 10,000 shares on the open market, spent $289,000.
That's a decent chunk of change.
It increased his personal holdings by 6.6%. Open market buys by high-level insiders are often seen as a strong vote of confidence, a bullish signal.
So high institutional ownership, concentrated but with a recent insider buy. What does that concentration mean overall?
Well, it's that double-edged sword again. It can mean a stable shareholder base that understands the long-term story, but it also means if one or two of those big funds decide to sell, it could put significant pressure on the stock price.
Right, liquidity risk if a big holder exits. Okay, let's transition to Chapter 6. Risk assessment. A classic SWOT analysis might help here. Strengths.
We've touched on many. Diversified products, those strong legacy brands like DonJoy and Aircast, the proven EGX system for integration, global scale, and the innovation pipeline with RVIs.
Weaknesses.
Also clear. The poor profitability and negative free cash flow on a GAAP basis. The high debt load, $1.39 billion. Significant integration risk, especially with big recent deals like Lima Corporate, and dependence on global supply chains.
Opportunities.
Big ones, those favorable demographics, aging population needing orthopedics, rapid tech advancement in healthcare, digitalization, and potential to expand further in emerging markets.
And threats.
Intense competition from bigger players, persistent pricing pressure from hospitals and insurers, and that complex, costly, ever-changing regulatory landscape. We also need to consider macroeconomic factors. How do things like inflation and interest rates affect Enovis?
Yeah, high inflation is tough. It pressures their margins as costs rise, and it can strain customer budgets. Higher interest rates are a double whammy.
How so?
Well, it directly increases the cost of servicing their $1.39 billion in debt. And it makes it more expensive for hospitals to finance big capital equipment purchases, which could potentially slow down demand for some of Enovis's systems.
Right. Then any specific geopolitical issues? Tariffs, maybe?
Yes, actually, new U.S. tariffs implemented in April 2025 are hitting them. There's a 25% tariff on medical devices coming from Canada and Mexico, and a broader 10% on most other imports.
Ouch. Did management quantify the impact?
They did. They explicitly guided for a $20 million negative impact just from these tariffs. It's like a direct tax hitting their cost of goods sold, another headwind to deal with.
Okay. Lots of moving parts there. Let's try to pull it all together in Chapter 7. Conclusion.
All right. Synthesizing findings. Let's recap the bull case. What makes Enovis potentially attractive?
Okay. Bull points. They've successfully transformed into a pure-play MedTech company. Revenue growth is strong, 17.1% CAGR. They own powerful, trusted brands. There's a clear path to profitability outlined by a new qualified CEO with that critical Danaher GX background.
And the valuation looks potentially cheap.
Exactly. Low multiples, that strong DCF estimate suggesting significant upside, and the recent insider buy add to the bull case. It's all about leveraging the EGX system now.
Now, the bear case. Why the skepticism?
The history of unprofitability and negative free cash flow is undeniable. High debt load and ongoing integration risks from all those acquisitions, intense competition, and significant macro and geopolitical headwinds, inflation, rates, those new tariffs.
A lot of hurdles still remain.
Definitely.
And to recap the valuation summary, that educational DCF model pointed to an intrinsic value around $52.20 per share.
That was the estimate, yes. Based on assumptions of 5–6% long-term growth and that 9–11% discount rate reflecting the risks.
So bringing it all together for a concluding outlook, the current share price, $30.44, is way below both analyst targets, averaging $52, and that DCF estimate.
It highlights the discount. Fundamentally, an investment in Enovis today feels like a bet on the new management team.
A bet they can use that EGX playbook effectively.
Exactly. A bet they can translate the strong brands and revenue growth into sustainable free cash flow and GAAP profitability, something the company hasn't consistently achieved yet.
So if they pull it off, the stock could be significantly undervalued.
That's the potential reward. But if they stumble, or if those external headwinds are just too strong, the debt and lack of profits could keep the stock price suppressed, or worse.
It really hinges on execution and perhaps some macro relief.
It does. Which leads to the final thought for you, the listener. Considering everything we've unpacked, the transformation, the brands, the debt, the new CEO, the risks, what stands out to you? What do you see as the biggest challenge or the greatest opportunity for Enovis going forward?
How do you personally weigh that promise of operational turnaround against the financial track record and those external pressures? Something to think about.
Definitely.
And that wraps up our deep dive today. Thank you for joining us. Remember, if you found this useful, please like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, more deep dives coming, especially covering the S&P 500 for members. And super thanks are always appreciated for specific requests.
Just the usual reminder, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice.
Please, do your own research, maybe talk to a qualified financial advisor before making any investment decisions.
We hope this deep dive into Enovis Corp is giving you a useful shortcut to being well informed.
Until next time, keep learning.